Asset is anything that has its own value. It is owned. It has its own value. It has its own presence altogether. Follow those methodology in order to achieve some value, some standards altogether. Sometimes a business might think that, sir, I don't have money with me right now. What should I do? At that point of time, so when I talk about this non-current asset, I would be looking into the future income, the future outcome altogether. Good morning and welcome to the session 5 on Unit 2, and in this we are going to speak about balance sheet. Everybody of us are really amazed by this word called as balance sheet. Why? Because that is going to talk about what the company is all about. So if you are not going to maintain a balance in the balance sheet reporting, definitely your company's future is going to be in trouble. So what is balance sheet exactly made of? Let's go and see. So the introduction to balance sheet is something like this. It summarizes the financial condition of business at a point in time. So what is that time? It might be in the month of March. Are you talking about September? Are you talking about November? Whatever might be the time factor, 6 months, quarterly, annual, or you talk about a 5 years or a 10 years down the lane, it's the balance sheet that is going to show you the way in terms of what the company is all about. If your balance sheet is not clean, if your balance sheet is not in a position to dictate terms, it's not in a position to tell what exactly the company is doing, then the investors will not be interested in taking the company seriously. So that is why I always say that balance sheet is the key document. It's the key asset altogether in terms of telling what the company is all about. That is going to be the performance indicator at any given point of time. Followed by, it estimates the net worth or the owner equity. So what is actually the owner's equity? What is the net worth of the company? Who is the owner? How much does he own in terms of the business? What is the presence of the company in the market? All this factor can be understood and addressed only by the balance sheet. Followed by most transactions affected on the balance sheet, so it can change daily. So balance sheet is not going to be a statutory, a mandatory factor that's going to remain there for hours together or for days together, just like that. Balance sheet is going to reflect each and every transaction, and it's going to tell people that, yes, I am going to change on a daily basis because there are certain factors which will be changing on a daily basis, which will be reflecting on a daily basis. So that's why I would always say that balance sheet is going to show on a current basis how things are changing, what are the factors that are changing on a day-to-day basis. Followed by the purpose of a balance sheet, everything that is owned by a business or an individual at any given point of time. So when we talk about accounting standards itself, the one word which I would like to talk about again and again is the word called as assets and liabilities. Whatever you are, in whatever terms you are, in whatever conditions you are, you cannot miss out on your assets and liabilities. Either you own something or you owe to somebody. That's what balance sheet always talks about. There are only two factors, assets and liabilities. More the assets, the company is in a positive position. More the liabilities, the company is in a negative position. So what people want to know about a company, a balance sheet can reveal it in minutes. So that's why balance sheet is the most important document. I would say that is the image of the company that we are speaking about. So every time when you look into the balance sheet, you will find something interesting that is running inside, deep inside, which is going to talk about what are the factors that we are talking about, the owning factor, the owed factor, and every other factor that we are looking into it. Similarly, we are also going to talk about the asset and liability in detail. So when I talk about asset, anything of the value that is owned, I'm slightly changing my definition here. Why? Because in the previous sessions and all, we would have talked about the productive use. But here, I'm going to talk about something very interesting called as the value that is owned. Now, for most of the company, asset is not something that can be created instantaneously. That can be something evaluated on the spot. Asset is something that the company takes a particular period of time to create and then start developing. So that's why I say asset is anything that has its own value. It is owned. It has its own value. It has its own presence altogether. And liability is like any debt or any other financial obligation, what we would like to talk about, which is owed to someone else, so somebody whom you need to pay back, somewhere where you have to give back this entire liability altogether. So that's why I would say that the assets and liability factors are very, very important. These are factors where you will start understanding that any debt that is there, that might be of a short term, that might be of a long term, whatever might be the factors, but these are the things that is being owed and you need to repay it back altogether. So that's why liability is always going to cost the company. Followed by the owner's equity or the net worth, the amount the owner has invested in the business. Now that is very, very important here. Why? Because when you talk about the owner's equity or the net worth, you will understand the amount the owner has invested. So everybody who starts up a business would have invested an X amount of money in terms of developing the business. And it becomes very, very important here that when you start looking into the business, when you start understanding the growth of the business, this is an important factor. What is the net worth? What is actually the business is worth of? Now, for example, let me look into Kotak Mahindra Bank. When we talk about Mr. Uday Kotak, the CEO and Managing Director of Kotak Mahindra Bank, and when RBI has again reinstated him back in position, automatically look at the net worth that has been created by Mr. Uday Kotak. He's worth more than 14,000 crores in terms of the owner's equity altogether. So that shows some presence in terms of having a person, having the owner in the organization. Followed by the balance idea. Now, how is the balance sheet balanced? How far it is balanced? The owner's equity is always equal to assets minus liability. So when we talk about the owner's equity, what is the real worth? This is the real worth, asset minus liability. So greater the asset, company is on the positive side. Greater the liability, it will be on the negative side. Moving forward. Now, the purpose of balance sheet can be completed any point of time. That is at any time what we try to talk about, which means to say that a balance sheet can be reflected, can be completed at any given point of time. It does not have a particular time period, though we say annual general meeting or we say annual factors and all that together, but then this can be completed at any point of time. So that's why I say that the purpose of a balance sheet is to look into at what time we are completing, at what time it is reflecting all the important factors. Followed by most are prepared at the end of the accounting period, represents both end of the year and beginning of the year. So let's say I started the accounting in the month of Jan and I ended in the month of December. So it's going to reflect both my beginning and my end period altogether. So that is where this is going to come into picture in terms of reporting, in terms of telling the value altogether. That is, now that's what I say, that the beginning of the year and the end of the year, this is useful in terms of comparison. This is useful in terms of analysis. This is useful in terms of telling how the company has performed in the previous years altogether. Now, what we need to follow guidelines of some recognized accounting sources. Now, for example, Farm Financial Standards Council for the farm finance, or for when we talk about the IFFC Council, or we talk about GAP, we talk about any of these standards. These are all the standards which are being created so that we follow those methodology in order to achieve some value, some standards altogether. Followed by, look at the general format of a balance sheet. One side we are talking about the assets, the other side we are talking about the liabilities. Under the assets, we have the current assets, the non-current assets, and the total assets. So the current plus the non-current will give you the total assets. At the same time, the liabilities, we have the current liabilities, and then we have the non-current liabilities, which finally ends up giving me the total liabilities. The owner's equity, all of you will know that this is the one where we're talking about the asset minus liability factor. Now, moving forward, what are the assets all about? Assets can be sold to generate additional cash. Now, that is very, very important here. Now, asset is something that we are trying to sell because we want to generate money. We want to make money out of this. So that is why we say that we need to sell the asset in order to generate the cash. So most of the time, asset is always looked into a factor which can be exchanged, which can be sold, which can be done in some format in order to generate a cash or its equivalent. We cannot look into asset as something which does not have a factor of holding it for a very long time, or it's something which will be remaining in the bank for years to come. But this is something where I would always like to say that it has got a lot of importance in terms of generating additional value to the system. Now, it is also used to produce other goods. Now, that is very important here. Why? Because when we are talking about the production of goods, this is always so important. Why? Because using an asset, you can produce other goods. Using an asset, you will be able to arrive at some value. So that is why I always say that asset is used to produce other goods. So this is very important. This is highly mandatory for all of us to know that how do we generate the value of the asset? How are we able to produce the value of other goods altogether? Followed by the current assets. Now, what do you mean by current asset? Goods that already have been produced and can also be sold quickly without disrupting the future production activities are known as current assets. Now, we can talk about grains, we can talk about livestock, other inventories. These are all the current assets, which means they are available with you at any given instance, at any given point of time, so that you don't have to look further at all. So if you can use that current asset that has been provided to you, you will be able to take it forward and convert it for any production activity. So that's why I always say that current assets can be sold very quickly, immediate convertibility to the cash factor. Now, where does this current asset actually come in from a balance sheet standpoint? When you talk about current assets, the one thing that comes into your mind is that you need to understand one important factor. Sometimes a business might think that, sir, I don't have money with me right now. What should I do? At that point of time, the business will come back and tell you that, yes, you will be able to generate that asset. You will be able to generate that business by selling a quick asset, that is like current asset, and we get the cash as fast as possible. So that's where the current assets comes into picture. The current asset will reflect the liquidity position of the company. So it is highly mandatory that you need to see that how fast you are able to convert an asset to the cash so that the business function does not get affected. Moving forward, the current assets will also have factors that can be ordinarily used up within the next year kind of thing is cash, checking and savings account, what we talk about, the marketable investment, the balances, accounts receivable, inventories from feed farms and other factors. Now, why do I talk about this current asset so important here is that the liquidity function today matters a lot in most of the business. When you take a construction business, for example, every day they require cash in terms of paying the labor and the materials altogether. So whenever they want to raise a capital or whenever they want to continue with the business altogether, they need to generate cash on a regular basis and the cash should be instantly available to them. So most of the time what happens is that the current asset position of the company matters a lot when we are talking about the business, when we are talking about the generation factors altogether. So that's why I would always say that when you are looking into the current assets of a company, it matters a lot. It really depends. Why? Because the current assets will definitely tell you how stable, how strong you are in terms of building up the system, in terms of building up the revenue altogether. Now, moving forward, the non-current assets. The non-current asset is something which is not a current asset. So as simple as that. Why? Because if I'm going to look into current asset, which means it is short, it is immediately convertible. But when I say it is a non-current asset altogether, that means it is not something that is easily available for me. Those assets are not owned primarily because to produce an output that will be sold or something like that. But these are something, the non-current assets, which would affect the firm's ability to in terms of the future income. So when I talk about the non-current assets, these are the assets that are available to me for a long run purpose. So when I talk about this non-current asset, I would be looking into the future income, the future outcome altogether. Like, let's say if I have a building, if I have a plant or a machinery altogether, I don't want that building or plant to be sold immediately, and it is not possible also. Over a period of time, the plant, the asset, the building, the land, everything will start gathering some value, and the value in turn will start increasing the asset value of the company. So in the long run, apart from the cash, apart from the profit that is being created by the company, these factors will also add value. So the non-current assets are one which are going to add value to the system in the long run. So that is why I would always say that the firm's ability to produce future income, it is not immediate. So if you look at Infosys today, apart from all the services provided, apart from all the factors that they have provided, apart from all the, the software generation that they have done, but what is the future income they have created through the assets also matters a lot. So that is why if you look into the investment, what Infosys has done in terms of land, building, the software or the equipments and gadgets, all those factors will definitely matter in terms of development. So that's why I always say that these are all of great value. These are all systems that can generate a huge amount of value for us. Moving forward, liabilities. Now, liability is an obligation or debt that is owed to someone. So we are, in return, we have to pay the money to someone because that is what is needed. At one point of time, you might ask this question, so what is this liability all about? Liability is all about that factor where you have to pay it to somebody because you borrowed and it is your mandatory duty to do so. So an outsider's claim against one or more asset of the building. Now, this is very, very interesting when we talk against the business factor. Somebody has got a claim on your business. Somebody has got a right to come knock at the doors of your company and say that, yes, sir, you need to repay back my money. Yes, sir, you need to tell people at that point of time that I have to give back the money. So that is where this is going to become a very, very important factor, a matter of stature altogether. So you need to repay back the money. You need to tell at that point of time, yes, I owe you and I have to give it back. So that matters how much of liability a company is accruing over a period of time. Followed by the current liabilities. Now, what are the current liabilities? The financial obligations that will become due within an year. So, accounts payable, your principal and your accumulated interest that we are talking about, which is payable over the particular current year. Now, principal payments on long-term loans, especially when we talk about your machinery and land, accrued expenses over a period of time, your accumulated interest, taxes and all those factors which is going to come to you in this current year itself. All these factors will matter a lot when we are talking about the current liabilities. So that is why I would always say current liabilities will make a matter of fact. Now, non-current liabilities. Now, all obligations that don't have to be paid in full within next year. So I don't have to pay it within the next year. Now, the non-current liabilities are one which will say that today I don't have to pay. I might have not to pay in 6 months or 1 year, but I have to pay it in 5 years or 10 years. So definitely this non-current liability will have a long-term impact in the business. Let's just try to understand this long-term liability. Why? Because the remaining balance on the long-term debt. So if a company is going to accrue long-term debt altogether, it will have an impact in the business running. But most of the business, what happens in a due course of time is that they accrue over in terms of the long-term liability. That's not their mistake, or that is not something they wantedly do. That happens because of the nature of business, the nature of borrowings and the factors. But this is not something on the negative part that we always have to think about. There are times because of creating a liability, the company might be able to create an asset in the long run also. So what we need to look as an analyst, as a decision maker, is that the liabilities will also get converted to asset. The long-term liabilities will have a far-reaching impact altogether from a balance sheet standpoint. With this, I come to the end of this session. I hope and believe that this session was highly interesting, useful, and in terms of a great resource for you. In the upcoming sessions, we will be talking more about the balance sheet factors and the other factors in terms of the international financial reporting standards. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful session.